In the final hour of trading on July 29th, the market experienced a sudden, aggressive wave of selling pressure, accelerating into the closing bell. This chart of the S&P 500 shows the objective result, a plunge forcing the index to close at 7,316.15. To understand the weight of this move, we look at the volume node at the bottom right, showing 1.18 billion units traded during that final hour. A volume profile of this magnitude indicates significant participation. This level of liquidity typically reflects institutional supply rather than a localized retail panic. This suggests the sell-off was not an instance of random distribution, but a coordinated repositioning of capital that we need to deconstruct. By examining the footprint left by this volume, we can begin to identify where that smart money was moving and why. Our objective is to reverse engineer the closing tape to establish actionable scenarios for the July 30 open. We will achieve this by evaluating index relative strength, analyzing the market's internal heat map, and identifying the specific catalysts on the economic calendar. Before we continue, please note this analysis reflects personal market interpretations and is not financial advice. Deconstructing the previous day's close is the professional standard for navigating the risk of the next day's open. We start by looking at the growth and tech-heavy NASDAQ, which showed significant underperformance during this window. The NASDAQ chart shows a cascading staircase of red candles, confirming a breakdown of structural support and a total daily loss of 1.38%. However, this tech-led liquidation looks very different when compared to the Dow Jones Industrial Average. On this chart, the Dow tells a more resilient story, ending the session with a much smaller loss of 0.44%. This divergence between industrials and tech reveals that institutional positioning was highly targeted rather than a broad market exit. Large-scale institutional capital was abandoning high-beta tech sectors while keeping the industrial core of the market structurally intact. This heat map confirms the rotation. Heavy tech selling is concentrated in semiconductors, with Micron falling nearly 10% alongside AMD and NVIDIA. This weakness hit Apple and Microsoft too. But looking right, capital flowed into energy and defensives, driving gains for Exxon and Walmart. Institutions typically park capital in these low-beta assets when they anticipate a period of high macro uncertainty. The rotation suggests that while funds were reducing their exposure to volatility, they were not exiting the market entirely. This raises the critical question: why were these funds rotating out of tech on July 29th? The answer lies in the economic docket for July 30th, which shows a dense cluster of high-impact data releases scheduled for the morning session. These include the advanced GDP and, most critically, the Core PCE price index at 8:30 a.m. Eastern. Core PCE is the Federal Reserve's preferred gauge for inflation, and it serves as the primary driver for interest rate expectations. Tech valuations are exceptionally sensitive to rising yields. If this inflation data comes in higher than expected, it could justify a more aggressive stance from the Fed. The heavy selling we saw on July 29th was the market front-running the risk of a hot PCE report the following morning. This setup defines the environment we expect before the 8:30 a.m. data release. We will likely see a range-bound, low-liquidity session as institutions remain on the sidelines, waiting for the official numbers. Attempting to trade in this pre-market vacuum carries significant risk until the data is released. Once public, the market follows two scenarios. Scenario A is a hot PCE print, showing inflation is not yet subsiding. This validates the previous day's sell-off. We expect the NASDAQ and S&P 500 to break support levels as liquidation continues. Alternatively, a cool PCE print means the July 29 tech sell-off was oversold, likely leading to a rapid V-shaped recovery. We would look for a sharp short-covering rally in the semiconductor names that absorbed the most damage during the previous session. July 29 established technical market boundaries, leaving July 30 data to determine the next expansion direction. Always maintain your risk parameters and refer to our earlier disclaimer. Until the market processes the PCE data, staying defensive is a valid approach to capital preservation.